how capital calls work with dual tranche syndication structures, because at the end of the market cycle, call it 2020, 21, 22, and beyond, because it's kind of been here to stay a little bit, are these dual class syndications where there's an embedded or synthetic preferred equity slice. And so that's a lot of words. And to simplify it, basically sponsors started to raise money in two forms. They would have a Class A tranche and a Class B tranche. The Class A would be essentially a preferred equity position that sat senior to the Class B, so they got paid first, and all they received was a current pay. So every month they would get 10% on their money, but none of the upside. So this appeals to the income-driven investor who probably wants some more downside protection. The Class B, on the other hand, appeals to the growth-minded investor because they sit subordinate to the A, and so they have to watch the A get paid their 10% first, and then they get any profit above and beyond what is paid to the Class A, their fixed rate of return. So it's basically adding more leverage to the deal, but in a more friendly way, because it's not like you're adding some third-party, scary, preferred equity, mezzanine debt or something like that that has teeth and default rights, remedies, foreclosure, that kind of stuff. So that became really popular because it was a way to essentially financially engineer better returns, and you're kind of slicing the deal up to give different people what they want to hopefully be like a win-win-win. Now, more cynically, you could look at it and say, well, you know, that's sponsors taking advantage of people and they don't know they can't identify the risks of the deal and so on, but that's not for today's conversation.